Right now, the most valuable AI companies on Earth are racing to sell you their stock. They are throwing open the doors, offering you a piece of the largest technology boom in history. But in finance, an open door is never a favor. Every trade needs a counterparty. If you are buying stock, someone else has to be willing to sell it to you. The people on the other side of that trade aren't random. They are the founders, the early employees, and the venture capitalists who built these companies and hold the internal data the public will never see. If these businesses are guaranteed to define the next century, why are the people who know them best in such a hurry to trade their shares for your cash? An initial public offering is a transaction defined by massive information asymmetry. The sellers are the most informed people in the room, which means the buyer is by definition at a severe disadvantage. Markets have tells. They don't come from press releases or television interviews. They come from watching what people actually do with their own money. The average investor panics and sells at the bottom, but the professionals do the exact opposite. As value investor Benjamin Graham and his student Warren Buffett understood, the smart money sells into peak optimism, right when the crowd is begging to get in. When the market is booming, insiders aggressively rush to take their companies public to extract the absolute maximum amount of cash from the retail buyer. There is a name for this specific pattern. I call it the Dinan Dash, and it shows up right before major financial bubbles burst. Take the summer of 2007. The markets were hot, and Blackstone founders Stephen Schwarzman and Peter Peterson decided to cash in, walking away with about $2.6 billion. A year later, the global financial crisis hit, and the stock plummeted 90%. This line chart tracks tech IPO listings, showing a massive spike in 1999. Concentration hit a record high just before the dot-com bubble popped. Following that peak, you can see a steep 75% cliff drop in market value as $5 trillion simply evaporated. Now, look at how the same timeline tracks the 2021 SPAC boom. We add a new peak representing over 600 blank check shell companies, raising $160 billion while bypassing normal vetting. And right after that, another severe downward drop shows an average loss of 67%. The dine and dash is a cyclical reality. When insiders are aggressively dumping stock, the top is actively being sold to the public. So what specific hidden math has the AI insiders so spooked right now? It comes down to the spending. This year, big tech is pouring $725 billion into building physical artificial intelligence infrastructure. To understand the sheer scale of that number, look at this horizontal bar chart scaling all the way up to $725 billion. That tiny tick mark at the bottom represents spending $1 million every single day for the last 2,000 years. It still doesn't reach the massive top bar. Now, place a second bar directly underneath it to represent the return. Over the last 12 months, the entire combined AI economy generated an estimated $110 billion in revenue. That is just 15% of what is being spent. When we morph that revenue bar into a pie chart showing real-world corporate AI rollouts, the picture gets worse. 95% of the area turns stark gray because those rollouts produce exactly zero measurable return. You can see this tension perfectly in OpenAI. Last year, they brought in $13 billion in revenue, but faced nearly $40 billion in losses. By their own internal estimates, they expect to burn well over $100 billion by 2029. Yet their valuation sits at an astronomical $852 billion. The math entirely fails to justify the valuations. The AI industry's current financials represent a massive, unsustainable black hole of capital. These current valuations are completely detached from business fundamentals. They are riding entirely on blind optimism. It echoes a warning from the summer of 2007. Months before the global financial system nearly collapsed, Citigroup CEO Chuck Prince admitted that when liquidity dries up, things get complicated. But he added, as long as the music is playing, you've got to get up and dance. Tech founders know the math is unsustainable, but they are caught in a vicious AI arms race, so they have to keep dancing and spending to stay alive. They don't know exactly when the music will stop. So their only rational move is to pass the risk off to the most enthusiastic crowd of buyers available, the public markets. Selling first allows insiders to lock in prices that assume a flawless, highly profitable future. They cash out, leaving all the risk of disappointment to you. Nobody has a magic stopwatch. It is impossible to predict the exact month or year this bubble will pop. But market fundamentals always eventually catch up to the hype. The gap between what is being spent and what is being earned will close. You don't need to predict the exact date of the crash. You simply need to read the room and observe what the smartest people are doing with their own money right now. You don't need to know exactly when the music stops. You just need to ensure you aren't the last one left on the dance floor.
But the AI bubble is the risk you can actually see. The valuations, the spending, the insiders selling. It's all right there in plain sight. The real danger might be sitting in a part of the market designed to stay invisible. While artificial intelligence and crypto capture the headlines, the largest institutional investors on Earth are moving their capital elsewhere, into an asset class so famously dull, it makes municipal bonds look exciting.
While artificial intelligence and crypto capture the headlines, the largest institutional investors on Earth are moving their capital elsewhere, into an asset class so famously dull it makes municipal bonds look exciting. This is private credit. It has ballooned into a market worth over $2.5 trillion, a figure that surpasses the entire economic output of Canada. Its performance history reveals why Wall Street is obsessed. Over the last 20 years, the stock market, shown here by the jagged line, returned an average of 10.2%. The smooth line represents private credit, which delivered 9.6% over the same period. Private credit mirrors the growth of the stock market while maintaining a level of consistency that public equities rarely achieve. This leads to a fundamental question. If an industry this massive can generate these kinds of returns with so little volatility, why does it remain largely invisible outside of Wall Street? Pension funds and university endowments manage about $30 trillion in global assets. This capital requires a specific destination, somewhere safe enough to protect retirement accounts, but profitable enough to outpace inflation. Private credit occupies a unique position for these managers. It offers yields significantly higher than traditional government bonds, while remaining insulated from the high-velocity speculation found in hedge funds. Public markets react instantly to macroeconomic anxiety. Stocks can swing 20% if Federal Reserve Chairman Jerome Powell so much as clears his throat during a press conference. Private credit operates with a much smoother cadence. This balance between high returns and low volatility emerged from a structural shift in the global economy, triggered by the 2008 financial crisis. In the early 2000s, traditional banks handed out corporate and mortgage loans with very few restrictions. They pioneered the ninja loan, lending to those with no income, no job, and no assets, and aggressively bundled that debt into massive investment products. When the risk finally caught up with the reality, historic institutions like Lehman Brothers collapsed, and the ensuing financial crisis nearly wiped out global markets. In response, government regulators rewrote the rulebook. Traditional banks were forced to increase their capital reserves, reduce their leverage, and adopt much more stringent lending standards. These rules created a gap in the lending spectrum. Local banks still served small businesses, and megacorporations could still issue bonds on Wall Street. But right in the middle, a void opened for mid-sized companies. Because these middle-market companies carry higher risk profiles, the new regulatory costs made them unprofitable for traditional banks. By 2010, the banking sector had effectively pulled back from this entire market. The demand for corporate debt remained, but with traditional banks retreating, the capital was forced to find a new, unregulated path. Non-bank lending firms, including giants like Blackstone, Apollo, and Ares, moved to fill this gap. They recognized the opportunity in the abandoned middle market and offered a new source of liquidity. Operating outside of traditional banking regulations allows these firms to move quickly. They cut direct, fast cash loans to companies, often without the exhaustive collateral requirements of a commercial bank. In exchange for this speed, borrowers accept steep interest rates, often reaching 10%, and a series of management fees. The result was explosive growth. From $300 billion in 2010, the assets managed in this sector rocketed upward, surpassing $1 trillion by 2020. Wall Street effectively constructed a parallel private banking system to capture the exact market that government regulators pushed out of the traditional system. This growth relies on a specific premise, that private credit is inherently more stable than other assets. However, that stability is often a product of how the industry reports its data. Public stocks are marked to market every second, with prices fluctuating based on real-time trades. Private credit is different. Because there is no public exchange, these loans are often represented by a flat line. Their value is estimated, not discovered by an open market. Without daily pricing, the true value of these loans remains hidden. The market only receives a clear update when a borrower finally stops making payments. Investors in private credit trade daily transparency for the perception of stability, as the true risks only become visible during a default. The systemic risks of corporate lending migrated out of the highly regulated banking sector and into the opaque world of shadow funds. This $2.5 trillion ecosystem currently functions on the assumption that middle market borrowers can indefinitely sustain 10% interest payments. That assumption has held for an entire decade. The payments have arrived, the reported returns have stayed consistent, and Wall Street has grown exceedingly wealthy from the flow of capital. Time will determine if private credit is a sustainable innovation or a $2.5 trillion bubble. We will only know for certain when the economic cycle turns and the black box finally opens.